Okay, Michael, let's go. We're live.
Are we? How come there was no French announcement at the beginning of this one?
Yeah. Sorry, like the little French sentence. This appeared a few episodes ago. Actually, we don't have this anymore now.
I'm so thankful for that. Martin tries to get us to do every episode in French, and he tries to have as
I'm
many
trying.
French-speaking guests as possible.
No, really. Bonjour, je m'appelle Philippe.
Oh, we can do it in French. Perfect. We can do it in French.
We're back at this again. Oh, God. Okay, well, let's welcome our guest, Philip Johnston, a co-founder and the co-CEO, do I have this right?
Yes.
Of Opontia,
Yes.
the e-commerce undercover. So I love the name of this company. Where does the name come from, by the way?
Well, firstly, thanks, Michael and Martin, for having me. Super awesome to be here. The name comes from so the most common cactus in the world is called an Opontia. And at home, I had these little Opontia cactuses. And I was trying to find the shortest word that I could get the .com for.
I love it.
That would give me free SEO. And this was the shortest word that would give me free SEO that I could get the .com for.
Okay, that you win.
But if you want the backronym or have the reverse engineered story, it's we're in the Middle East, and cactuses are resilient and they can grow anywhere. That's us.
I like it. I like it. But I do love this double meaning, right? In other words, in the old days, you had companies like Tumblr, right? TUMBLR. So they started removing vowels, and then everything had like that kind of vibe to it. But you've run out of like 3-letter, 4-letter domain names. Even if you probably couldn't get cactus.com for sure, right?
No, yeah. Opontia.com, there's no way we can get, but Opontia we can get. So Opontia we couldn't get, but Opontia we got.
So fair enough, but no one's going to know, right?
So all around our office, we have these little Opontia cactuses because it's a super common cactus. But it wasn't until afterwards that I was told that cactuses are actually not native to the Gulf or any of that region. So yeah, you only find them in Mexico. So
that is even better. Hey, before we talk more about the Middle East, why don't we get some of your background for some context, and then we'll jump into the main part of this conversation, yeah?
Yeah, sure. So I was born in the UK. When I was very young, I moved to South Africa. I'm the youngest of 5 boys. I have an identical twin brother. My twin brother's actually the founder of Una Brands, which is another one in Southeast Asia, these e-commerce roll-ups. Yeah. Then lived there for the first 5 years of my life. My dad was a diplomat, that's why we moved there. Then moved back to the UK, studied math for undergrad in the north of England. Then went to the US to study a master's in mathematical finance in New York City, in Columbia. And then I spent 5 years doing currency derivatives trading for BNP Paribas, 2 years voice trading, and then 3 years like algo high frequency trading.
Oh, nice.
So I split between Singapore, London, and New York. Spent a couple of years in London, a couple of years in Singapore, and a bit of time in New York. And then kind of got a bit bored of that. So I sort of was working in Singapore. I quit my job on a Friday. I flew to South Africa, and I started working for a VC fund the following Monday as an intern. And I took like a 95% pay cut. So yeah, I did that for about a year. Eventually, they started paying me properly, which was nice of them, or at least better than 95%. Did that for a year. Then I went to the US to do MBA, MPA. So I spent 3 years, MBA at Wharton, MPA at Harvard Kennedy School. So that's like a government degree.
Yep.
Then I spent, I then came back and did VC a bit in Kenya. Then I spent 2 years at McKinsey in Dubai, and then a year ago I founded this. And the way that it came to founding this was when I was doing VC in South Africa and Kenya, I sort of realized that a ton of small e-commerce founders were looking for funding from VCs, and we would get tons of applications. But the business model was not really VC backable because they didn't have some kind of platform. If you're selling kitchenware on Amazon, it's not really like a VC backable model. But that's not to say they weren't great businesses. They're very profitable, growing. And secondly, the founders had reached a point where they didn't really have the expertise anymore or the resources to continue growing the brands, and they would rather just go back to brand building, creating new brands. And there was no way for them to exit. So we founded it basically because we saw there was a need, from entrepreneurs for this exit route. And also, so basically what we do is we buy businesses, grow them as fast as possible, but then we give the founder some share in the growth in profit after we've grown them. So that's generally where it came from.
So there's so many things to unpack there.
Yeah.
I'm really curious about the time that you said you studied mathematical finance. Was there a programming angle to that as well? In other words, do you program too?
Yes. I mean, I did a program a bit when I was at BNP as well, but it was more like writing research code in R.
In R, okay.
Yeah. And a bit of Python, a bit of Java, but not really. So there was... And also actually VBA, like, I don't know if you call VBA programming, but some of the VBA...
I did it and I don't consider it programming because I could do it. So it can't be programming.
Yeah, right. Finally, in that case, no. I don't consider VBA programming either, but I mean, some of the VBA we wrote was like, biblical, one might say.
I like it. But do you think you can take some of the sensibility that a programmer has and all the organization and all the logic then and apply it to the business you're doing right now, if you know what I mean? Because it's very systematic, right? At some level, no?
Yes. Yeah, it's super systematic. Well, I'd say there's two parts to like brand management and like managing these brands. Number one is, yes, you need to be extremely data-driven and extremely methodical and but you can't miss the creative element or the creative aspect of it, especially with like Shopify brands, for example, where if you're going to try and drive traffic to the site, it's not about do you have the lowest price or do you have the highest PPC visibility. It's about, can you get an influencer to make something look appealing to a bunch of people, and that requires actually some creativity.
So this is the other thing that's really interesting to me, right? Again, I worked with a guy at Goldman who studied engineering in school and then did some HFT, right? Some high frequency trading. You know this from writing the programs that do high frequency trading. And that is, you're trying to reduce the noise in the back testing that you're doing, right? And try to elicit signals, right? And that's what you're really looking for good signals. But discovering those things, and discovery is something I talk about a lot. How do you determine like which brands are good and which brands are bad in all the noise that you're finding out there? And how do you know like what to acquire?
Yeah, well, I would say it's much easier for us because our geographies are much less developed. So like where you might have 1 million sellers in Amazon US, we have like 30,000. So in like Amazon.ae or Amazon Saudi Arabia. So AE is the UAE and then Saudi.
So you're operating in the Middle East, or in the GCC, to be fair.
Actually, we're operating CEMEA, so Central and Eastern Europe, Middle East and Africa is our target geographies.
Got it. So MENA and Central Europe.
Yeah, and Central and Eastern Europe. So we have offices in Poland, Turkey, Saudi, UAE. And so the reason that we're doing these geographies is basically because nobody else is doing them.
Got it.
So and also because they don't have Amazon actually. So like Poland is run on Allegro, it's a big platform, but there's no Amazon has like 2% market share. Turkey has Trendyol and Hepsiburada, where Amazon is like 10%, and then UAE and Saudi it's Noon.com and a few other marketplaces, and Amazon is like less than 20%. So what that means is it's very hard for Thrasio or anybody else to come in. So we can build a very strong ground game in terms of like setting up the operational capabilities, and then we have a super strong moat around our business. That's our philosophy.
Yeah, I mean, it's hard to talk about this whole space, right, without talking about Thrasio. They've raised, I don't know, pick a number, $1 billion, more than $1 billion.
Yeah, much
but
more,
way more. But are you suggesting then that you're not aggregating Amazon sellers because their percentage of market share in the markets in which you're operating is so low, but that you're, dealing with like Souk.com and other other platforms like that? Yeah.
Yeah. Well, Souk.com just got bought by or like a few years ago got bought by Amazon.
Got bought by Amazon. Yeah.
But it's more like Noon.com, and then there's Carrefour, Mom's World, Spree. Like there's a whole bunch of regional marketplaces. So I'd say Amazon has about 20% of the market in Saudi and UAE. So we'll buy Amazon businesses too, but we'd rather buy. Actually, no, we don't mind so long as basically the brands we buy are targeting consumers in our regions.
Got it.
That's our criteria. Because if we buy a brand that's based in the UAE but sells only in the US, so what they do then probably is they source from China, ship straight to the US, stick it in an FBA warehouse there, and then it's like, well, Thrasio is going to buy that. So the reason Thrasio can pay much higher multiples than we can pay because they can justify it because they know they're going to have this big US market. So we don't want to. We're not trying to compete with Thrasio in the US market, basically.
Do you worry about, the arbitrage going away? You know what I mean?
What do you
I read
mean?
an article.
Yeah.
So I read an article
going up.
Yeah, multiples going up to a point where, like, if you do a DCF calculation or an IRR calculation about what your future cash flows are going to be, but plus your current purchase price, that at the end of the day, the returns aren't going to be high enough to justify the investment that you thought was going to happen. But if you're bidding and somebody else is bidding, you know what I mean?
Yeah, I know what you mean. I'm not that worried, to be honest. I mean, I think they're calling it a gold rush for a good reason, which is multiples are so low right now. I know they're going up and they've been going up for a long time, but even Thrasio doesn't really pay in terms of upfront cash. They don't really pay more than 4 times EBITDA or 4 times SDE, so discretionary earnings. And 4 times is unbelievably low, given that you're buying a fast-growing. Yeah, it's extremely cheap. So, and that's, by the way, fiercely competitive. So that's in US and Europe where there's like 30 or 40 very well-funded competitors. So yes, they'll go. The multiples will go up, but we might end up in an end state, something like India, where multiples are like 6. But even at 6, that's if you buy something for 6, that means you only need to fund your cost of debt at something less than 1/6, so like 16.6%.
Right.
And all of these guys are now funding themselves at like 6%. So if you fund yourself at 6%, you can basically pay at least 10 times. And that gives you room to cover your central costs. So I don't see, unless they go more than 10 times EBITDA, I don't see why this would be a problem.
So is this a business that's essentially not only, but taking advantage of the fact that interest rates globally, particularly short-term rates, are zero, essentially, right? Or 25 basis points, pick a number you like, and have been there for a long time. And even though there are whispers about raising rates because of potential inflation, you still think that the funding rates, because a lot of the capital that gets raised in these businesses is not equity, right? It's debt.
Yeah.
So you think that it's still going to be cheap to raise debt going forward, so that the acquisition of these businesses is still going to be cheap enough to be able to create the proper returns?
So long as, I think it would take the US base rate would have to go up a lot for it to become unviable. I think it would have to be like above 5%, which is quite a way off, I think.
Yeah, I mean, depending on what the curve does, right? But yeah,
true. Yeah, but like the 1 or 2 year funding rate would need to be above 5, which I don't see that
not
happening.
going to happen.
Yeah.
It's probably never going to happen in your lifetime, actually.
Let's hope, because I have a lot of dollar-denominated debt right now. My grad school loans, I'm extremely illiquid at the moment.
Oh no.
So I don't see that being a problem. And also, if it does happen, what would happen would be that the multiples then would fall in e-commerce businesses, and there would still be a market for e-commerce brands. And there would still be people who are successful at doing it. It would just sort of shake out the people who are bad at doing it. And right now, whether you're good or bad at doing it, you're making money because they're so low in general. But as it approaches a point where some people will and some people won't make money, that's when it'll become easy to see who's good at it.
Do you care if the founders of the businesses that you're buying, or it's more like a brand, right? Do you care if they stay on? In other words, entrepreneurs are like a strange breed, right? Like, they hustle really hard. They really care about this thing.
Yeah.
You know what I mean?
Yeah. My opinion on this has changed slightly over the last few months. We used to prefer founders who were looking to exit and not be super involved with the business.
Interesting.
Because once you give somebody a bunch of money, they're not then that super incentivized to
motivated,
work at it. Yeah. But it's actually, we're finding that we need them to stay on a bit and to be more heavily involved than we thought we'd need them to be. So now we're trying to find more, trying to have more of a transition period.
Does that change the incentive structure that you build for them?
Yeah. So now we try and put more into the earnout, basically.
Can I ask you this though? Like, I'm really curious about this process. Let's say I'm a brand owner. I built this thing. It's growing. Like, pick a number that you like a lot. It's growing. I can show you that it's growing. You come to acquire me. I'm kind of excited. You're right, because I've seen this in my own experience in Southeast Asia. E-commerce is hard, right? And it's technically really hard, but also the warehousing and all the delivery and the logistics is super difficult, particularly if you get to scale. And if my warehouse is like my living room, like, it just gets really hard. And you're smiling, but you know that happens, right? I've seen it happen as well.
Definitely, yeah.
But what is the process? Let's say I built this great brand like Michael's Bikes or whatever, and you buy it. What's the process of like integrating me into the process? Do you know what I mean?
Yeah.
Like, what changes for me? Like, on day one, I come and I'm like, okay, now I'm part of Opontia. So what happens?
Yeah. Well, it's a long process up till day one as well. So, I mean, first we reach out to you, we sign an NDA, we see if you're interested in selling. We then gather a whole bunch of information from you. We make you an offer. If that works for you, then we do like a month-long DD where we, operational DD, commercial, legal, financial, all the rest of it. Which, it's not the easiest process in the world. We try and make it as smooth as possible, but it definitely takes a bit of time. And so when it gets to day one, we already have a very strong relationship and we know exactly what's going to happen on day one. We have like laid out a roadmap for how we're going to integrate. So the first things that happen are, we then take over the accounts, so all the login details and everything. So we start managing all of the content creation, pricing, all of this type of stuff. We then move your inventory to our warehouse provider. So we partner with another warehouse provider. So that usually makes things much more efficient, to be honest. And then we carry on running the brand, basically.
So is there data sharing? And I guess I should give you more detail on what I mean. I'm selling mattresses, let's say.
Yeah.
And I'm doing a killer job doing this, right? But you also buy like a pillow brand or like a sheets brand, yeah? Do you then aggregate that data so that you know that the people that are buying mattresses are then going to buy pillows and sheets as well? Yeah.
Yes. I mean, it depends. So Amazon FBA, they don't give you their customer data, which is super annoying. And they give you less and less of it. They used to even give you, like, is it a male or female? Is it this and that? But now they just give you sort of broad cohorts of customers.
Really?
Yeah. And they're trying to really keep hold of their data. So with Shopify, you know everything about the customer, even their email address and phone number and everything. So then cross-selling between the products becomes a lot easier.
So
do you do
Amazon,
that?
Go ahead, Martin.
Yeah, no, just I was wondering, like, if this is part of your growth strategy, like to use the data, to use the email address, and all of that, to then cross-sell between the brands that you buy. Because as Michael said, if he has a brand selling mattress and I have a brand that sell pillow, for example, then if you buy both of them, then the customer of one brand can buy the product of the other brands, right? So is it something that you do as well?
Yes. Yeah, definitely. Okay. No, and we've hired a bunch of like data science people to help us with that as well.
To do that for you. And actually, by doing that, your model is quite different than what Thrasio and all of the other aggregators are doing, because they focus mainly on Amazon, so they cannot do that. But for you, if you buy DTC brand, then that's definitely something that you can do for growing the brand. But on the other side, they can use Amazon FBA to fulfill all the orders. So how do you handle that part? You talk about the partner that you are working with, right?
Yeah, exactly. So in each country we operate in, we have to have a logistics provider who ships like a mid-mile warehouse, and they ship to the Amazon warehouses, but they also fulfill last mile from from the mid-mile warehouse. Yeah.
Okay, so you replace basically like the Amazon FBA by your own logistic provider, like kind of what they did in the US with FBM. We saw a lot of warehouses building around Amazon sellers as well, but who could fulfill the orders by themselves, right?
Yeah, exactly.
Okay, so this is how you tackle that. That's cool.
Yeah.
So what did you think of and this just popped in my mind because you've mentioned Shopify a couple of times. What did you think of Shopify's investment in Shogun?
To be honest, I don't know about that. I should be reading more e-commerce.
No, it's okay. It's okay. I'll tell you what it is. It's not meant to be a trick question like that at all. No. Shogun's a company that provides like a page builder and like they automate the store building process, right? So Shopify has all these tools and all these plugins.
Yeah.
And Shopify's built a platform into which other people can build businesses. You know this. And Shogun is one that's been funded externally with a valuation of, I think, $650 or $700 million. So they've done a super good job.
Wow.
But they've built a builder, right? So that a website builder, so that store owners on Shopify, because Shopify gives you literally like very few choices for customization for your store, right? So, my mattress store is going to look a lot like Martin's pillow store kind of thing.
Yeah.
But Shogun's built this thing.
My store is not going to be built on Shopify, Michael, but yeah.
I know that. It's going to be built on Dr. Tech. We can argue about that later.
But if it wasn't Shopify.
I think it sounds like a very smart acquisition from what you're saying.
Yeah, it's just interesting to me. I guess the further question to me is, do you see taking your brands, because I want to know what the opinion is of like marketplaces versus individual sellers, right? And I'll tell you why. And I ask this question a lot, and I love to get answers for this. In the old days, offline, there were these main streets that had little individual shops on it, right? And then they all got consolidated into department stores. But then it got noisy in the department stores, and discovery was hard. So they took the brands out and put them back on Madison Avenue or put them back on High Street, right? Because that was a better way to do it. And I think the same thing that happened offline is going to happen online. So when you look at the brands that you're acquiring on these other marketplaces, do you think then about taking them off the marketplaces, trying to remove some of the noise and creating your own marketplace? You know what I mean? Where just your brands are just on like Opontia, and that becomes the marketplace?
I think what we won't do is create our own marketplace, but what we definitely will do is create individual Shopify stores for each brand. So each brand we buy will have their own, like we bought a medical pillows brand called Novamed that was only selling on Amazon and Noon. So now we have novamed.org, and we sell through their own Shopify site, basically. So yeah, I think that makes sense. But having a Opontia marketplace, I don't think makes sense, because then we're then competing with Amazon and Noon, which, I mean, all of our brands are fairly disparate. So it's not like we can say we're the medical accessories player, because one brand is medical pillows, but then the next one could be bath bombs, and the next one is whatever else. So yeah, I'm not sure we're going to have our own marketplace, to be honest.
Yeah, the only reason why I think about this, right, is because, and I've asked this before as well, is, Intel used to do this thing. They still do it, but it was more popular before. They did this thing called Intel Inside. So you knew if you were buying like a computer, even if it didn't have an AMD chip, like you knew it was Intel, and they marketed like that. Like, do you see something where it would be powerful to say like powered by Opontia? Yeah.
Yeah, I see what you're saying. Yeah, I've thought about this a bit. I think on balance, probably no, to be honest.
Okay.
And the reason, I see why you say yes, and it's a bit like for example, Marriott hotels. Like, if I stay at some like I'm quite a fan of any hotel that says, even if it's called like the Renaissance or the whatever it is, if it says like by Marriott underneath it, I know it's like a good brand.
Right.
Or like it has a certain level of standard. But I think yeah, maybe that would make sense. But I think when we're buying, you also kind of lose the value of the individual brand by doing that. Because some people don't like Marriott, for example, and some people wouldn't stay at the Renaissance if it's by Marriott. But like for example, like I think P&G is a very good example of this. Like P&G owns 50 different toothpaste brands, but they would never say Colgate by P&G, SR by P&G, because they're trying to get a different customer segment. They're trying to be as differentiated as possible within each toothpaste brand, so that they capture a different customer segment. And I think we're kind of similar to P&G in that regard. So like if we have a bunch of different brands, like we might have, the high-end medical pillows brand, the low-end medical pillow brand, you don't then want to have them be the same brand, because you're trying to differentiate the customer segment base that you can sell to. What do you think?
I understand.
Yeah.
Interesting. So if one day you change your mind and you decide to do that, that gives you one good reason to come back on the show to talk about that.
Yeah, I'll be like, you were right.
Let's be clear about this. I'm rarely right. But I'm always curious.
Yeah.
And I mean, I mentioned this to you before, Philip. Like, one of the reasons why I do all these different shows is I try to take the things that I learned from one of them and try to make equivalencies on others, right? So like, I'm also really interested in the tech platform that you're building, because there's no way you can individually or independently go through like all the data for every one of the brands that you want to buy. And the more you do, the more you have to buy, right, to keep the returns higher. Yeah. So is there a tech automation process that you're working on or that you've built as well to be able to do some of that analysis for you?
Yeah, definitely. And to be honest, this is where I quickly get out of my depths. So I'm I'm more so I have a co-founder, Manfred, who's like the e-commerce guru. He was chief commercial officer of Lazada, and Lazada in Southeast Asia.
Of course. I mean,
it's everywhere in Thailand.
Yeah. So my co-founder is like the e-commerce guy, and I'm more the sort of financing guy. So he's building out and hiring all the tech team and building that out. But basically, in a nutshell, what we're trying to do is create, because we have to manage this omni-channel approach where we have to ship to all of these different platforms. It's not just an Amazon FBA approach. It's about integrating the OMS, WMS, like order management system, warehouse management system. It's about integrating that with the ERP and the sourcing and everything else to create sort of forecasting and demand planning, and then automated pricing updates across the platforms, automated scraping to know when we should do pricing updates. All of that type of thing is going to be a big piece. Yeah.
Wow. That's so we're going to have to get Manfred on the show too.
Oh yeah. And like, he'll go on, because he was in Malaysia for ages. So he was in KL. So I'm sure he can talk about Bangkok and stuff.
Yeah, no, I'd love to know. Go ahead, Martin. You were saying?
No, that's made me think about what Bluestorm is doing with the PIM, the product information management system, where they create like a database that is kind of like outside of Shopify or Amazon or something like that, but thanks to API, then they can connect to everything. So then you only have to go inside the PM to change the information or to update something or to work on your product there, and then it's going to update everywhere at once. So that's really, really useful into that sense for companies that have hundreds of thousands of products. So basically not your individual online sellers, but all of them combined, it can represent tons of product, and maybe that can make sense to go to that kind of infrastructure to manage like the whole bunch of products.
So what is the exciting part for you about the finance side of this? In other words, what's the innovation you think you can bring that hasn't been done yet, right?
Well, certainly in our regions, we just raised venture debt. So we raised 25 million from PFG, Partners for Growth. It's a San Francisco-based venture debt fund. So we're the only I think we're one of the only people ever to raise venture debt in our regions. So like as a 9-month-old company with almost no revenues, it's basically impossible to raise debt in our region.
Yeah.
And so I'm now getting all the startups in the region are like, how do you raise debt in this? Like,
what kind of magic was involved in that?
Yeah. And we spoke to like 50 different providers. We had 6 term sheets for the debt in the end. And we went with the one which we thought could actually deploy in our regions. Because, for example, in Saudi, there was no legal structure for debt until 2 years ago, because it was illegal under Sharia law to even do debt. So, yeah, I think that's an interesting piece, is the whole venture debt thing.
Yeah. Are there other sort of nuances in the markets in which you're operating, I think, that would surprise people? Let me give you an example. People look at Southeast Asia and just think one big monolithic market. But Indonesia, like you said, because of Sharia law and because of the inability to raise debt, the takaful, which is also sort of Muslim financing, is different. Vietnam is a completely different market than Cambodia, which is different than Thailand. And again, the regulatory environment is completely different in all of these countries. What are some of the challenges you have of operating in these different places, particularly from a financing standpoint?
Yeah, I mean, I think that's one thing, is just how immature debt is. The second thing is, so our countries are, Poland, Turkey, Saudi, UAE. Poland is the easiest by a mile. Turkey, I don't know if you've been following what happened to the Turkish Lira over the last couple of months, but it's a roller coaster. Like, it went from 11 to 18, and now it's back down at 11 again.
A little volatility for anybody?
Yeah, it's worse than Bitcoin. So that's one thing, and we're trying to get our debt providers comfortable with us deploying dollars into Turkey, which, again, nobody has ever done that before.
Really?
In the last 3 years at least, nobody's been willing to deploy debt, and we're doing it at the most volatile time. So yeah, it's a bit of a mess.
What is there a quanto there in the sense that, like, you're bringing dollars in, but the businesses are getting done in the Turkish lira, but they have to then get converted back into dollars to come back into your business? Yeah,
exactly. So to repay the debt, we have to repay it in dollars, and if we're generating lira and it's depreciating 50% a year, we would have to grow the business at least that to make up for the shortfall.
Right.
Yeah, let's see. I mean, it seems to be heading in a better direction now, but I mean, just the volatility is something we need to be very careful of.
Yeah, it's just interesting, right?
Yeah. And then I would love to do Russia as well, but so Russia's about the same size as all of our other markets combined, and nobody's doing this business in Russia right now. Maybe I shouldn't have said that.
It's okay. So it's interesting because I didn't even think about it, but is there a big e-commerce platform in Russia that we don't know about? And are there individual sellers as well?
Yeah, it's a bit more fragmented than other markets. I think there's 4 or 5. The big ones have 20%,
Okay.
So, yeah, but I mean, the thing is with this business model, it doesn't really matter so long as you can find brands that are profitable. You know that they must have figured it out, right? So if they figured it out with one person, not really having much e-commerce experience, then we can figure it out with a whole team of what we hope are e-commerce experts. So that's the thing that makes me confident that we could pull off Russia but the thing is, no debt provider would let us go into Russia, especially not now. They're trying to mass troops on the border with Ukraine and all this stuff.
Right. And yeah, I mean, Russia is its own little animal. We can have a conversation about the geopolitics of Russia and what they're trying to do, I think, in a different setting. I don't really want to do that today. I'm actually curious as well about what that capital raising is like. So you recently announced a Series A raise, right?
Yeah.
And one of the things that you said, and you've said it again, is that you've only been around for 9 months.
Yeah.
And you went out and raised a pretty decent amount of money, particularly for the region in which you're operating, right? Like you said, if you're operating in the United States, it's just a different metric, but you're not.
Yeah.
What were those conversations like? I think everything's like a conversion problem, right? So if you want to raise money, you probably have to talk to 100 people to get 3 people to say yes. But I'm curious, when you went there, because they don't understand the regions where you're operating, I'm curious what those conversations were like. Yeah.
Yeah, well, most of our equity was raised by local investors. In fact, the bulk of the Series A was from Saudi investors. And so,
Really?
yeah, but I mean, Saudi is plowing money into VC globally. I mean, SoftBank,
Yeah,
I
no,
don't
I
know if
know.
you know that. Yeah. So they're all, I mean, Saudi is like the best place to. So Saudi's kind of like leading the way in VC in a lot of ways, to be honest. Certainly in the
Well,
region.
they're
But
one of the biggest investors in the Vision Fund, right? Which is run by
yeah, exactly.
Masayoshi Son, right? So SoftBank. Yeah. Sorry, go ahead.
Yeah. So that was super helpful on the equity side. On the debt side, people were super keen to talk to us in general, and we had a lot of inbounds actually. Even Morgan Stanley's New York-based fund, like some super conservative investors you wouldn't expect. And they would give us term sheets, and then they would start looking at the legals, and they'd go,
Why
So,
though?
just because they couldn't be bothered to spend, because for example, taking security on, like doing share pledges, which is quite. Do you know about share pledges? Like,
Yep.
it's quite a standard. Basically, for the sub holding company, we have a holdco in Singapore, and then we have sub holdcos in each country, and they wanted to take share pledges in each one, which basically means, for the listeners in case they don't know, if we default, we couldn't, for example, sell off one company just before we default, so that we avoid having to give it to the lender. So that's what share pledge means, basically, is that we've put our shares in escrow somewhere that I think roughly that's what it means. So that as a concept is barely done ever in the UAE and Saudi. So the US investors were like, just even getting our head around it, they can do 4 deals that are twice the size in the same time it's going to take them to figure out doing our deal. So they really have to be invested in the concept.
I understand. Yeah, I mean, I have my own opinions on venture capitalists, but we'll leave that to another time as well.
No,
I'm
I want to
curious
hear
about.
what's your opinion?
Well, first of all, I don't think they take a lot of risk. I don't think they're in the risk-taking business at all. I think the
Venture
earlier,
capitalists.
yeah,
Go
particularly
on.
the ones that
That's a
fund like
controversial
Series A.
opinion, Michael.
Yeah, say that again.
That's a controversial opinion, Michael. You have to just back that
Well,
up.
it is indeed, but I'll tell you why.
Yeah.
Because so you raised money in your region from Saudi, right? And Saudi has, all this oil money, and they're trying to take some of the money out of the petroleum business and put it into other technology businesses, because the Saudis actually have been super smart, right? They've realized that at some point oil is going to go away, and the whole market's moving towards tech. Like, that's the way the world is going, and you can't get tech out of the ground. So if you don't take that money that's literally coming out of the ground in Saudi Arabia and in the rest of the Middle East and invest it in technology, you're going to miss out on what the future of the world is, right? So fair enough.
Yeah.
But most of their investments historically, even in the VC space, and the Vision Fund is the perfect example of this, have been in growth companies, not in early stage companies. Because it's at the earliest stages of investment where you're investing in an idea, which is really an experiment. Like any investment into your company, it's kind of an experiment because you don't know if it's going to work. Sure, it's working in the US, and we'll talk to your twin as well, but it's kind of working in Southeast Asia. But no one's done it in the markets where you're doing it. So it's an experiment in a way, and that's super cool. But your general VCs will fund Series A, Series B, Series C, because the product market fit's already been found. The growth is already there, and all they're trying to do is accelerate growth. That's not risk taking.
Yeah,
is
fair.
it?
I see what you mean. I see what you're saying. I agree. Yeah, I think so. Like you'd say seed stage investors can be classified as risk taking, whereas Series A is more like growth, and you're just sort of trying to find a thing that's working and push it along a bit.
Yeah, so I think that seed stage investors are getting on a surfboard and surfing in a place where no one surfed before, right? So they're the guys that go out into the middle of the ocean and find these gigantic 100-foot waves that no one's seen before. And I think VCs are kind of waiting for that wave to come into the shore and just go, yeah, it's a pipeline. It's a really hard wave to surf, but we've seen this wave before. We're just going to get on that one instead because it's much less risky. And there's way more data on it as well. Yeah, that's what I mean.
Makes sense.
I'm also curious as well about what some of the rules are. So in Southeast Asia, right, like in Thailand, you can't give stock options to company owners, which is why most companies then get incorporated in Singapore.
Okay.
Yeah, and you also can't do convertible notes in Thailand and in Malaysia, I believe, and in Indonesia. I'm wondering what it's like in the Middle East and in some of the countries where you operate, because you are founders, right? Even if you don't give them equity, maybe you write them options, maybe you write them convertible notes. Is that possible where you operate or no?
We incorporated in Singapore, so yeah, our holdco structure is in Singapore.
Yeah, yours is, but I'm talking about your founders. So like Novimed was a
we
company that you
buy them out,
right?
so yeah,
You buy them out completely.
Yeah, we have to, because otherwise we can't draw debt to do it. But we write them a contract that says, hey, we give you a percentage of profit, future profit, basically. So
That's really interesting.
Yeah. So it's kind of like,
Go ahead.
I mean, it's kind of like they are still an owner for a fixed period, but legally they're not an owner, and we just have a contract with them. Yeah.
What's it like when you run up against a brand that's like doing really well, you're super interested in buying it, you make a bid for them, and they just go, never mind. Do you know what I mean?
Yeah.
Like, what is that like, and why would they say no? Have you had that happen?
Yeah, I mean, it happens a lot. If you're fast growing, then you might say, why would I sell? Yeah, I mean, I'd say it happens at least half the time.
Really?
Usually we don't make a bid for them at that point, though. Usually they know in the first couple of conversations we say roughly what we'd pay, what multiple of EBITDA would pay. And at that point they'll say, yes, I'm interested in this, or no, I'm not that interested. And if they're not interested, then we wouldn't even bother going down the whole DD route and making a bid.
And do they change their mind sometime? Or if they say no first, then they just
they do. Like very often somebody will say no, and then 3 months later they'll be like, actually.
What was Philip's phone number again?
Yeah, exactly.
Is it because they didn't get the growth that they wanted to have, or maybe their growth slowed down or something like that? Or
and they think about it and they're like, because it's a grind running an e-commerce business.
It is. It's hard.
An absolute grind. Yeah. So sometimes they're like, I could probably retire if I took this now.
Okay. And can you walk us through a little bit through the process of how you grow a brand? Like once you acquire them, what do you do after that to grow them?
Yes. So we have sort of 5 ways of growing revenue to top line and 3 ways of cutting cost. So on the top line, geographic expansion, product line expansion, channel expansion. So that means like if they're not selling on Shopify, we do that. If they're not selling on Amazon, we do that. Investment in working capital, that's both marketing spend and inventory. And then the last one is what we call like the e-commerce tips and tricks. So like all the optimization and technical know-how, how to boost your rankings and all this type of thing.
Like what, for example? Can you give us like 1 or 2?
Like for example, if you're ranked number 11 on Amazon and there's only 10 on the first sheet, you get a much more incremental boost in sales by going from 11 to 10 than you do from 10 to 9. So things like that sellers don't think about, many sellers don't think about. So boosting your PPC when you're number 10 is much more valuable than boosting your PPC also when you're number 11 is much more valuable than boosting it when you're number 10.
Interesting.
Just like these types of things that sellers don't really think about, that and all the analytics and conversion and CAC and all this stuff that sellers don't really worry about.
That's interesting. And
how about you mentioned cost cutting as well? Sorry.
Yeah, and on the cost cutting side, there's 3 ways. So we cut the COGS because we can source cheaper than they can source. So usually we renegotiate the supplier contracts because we're going to buy bigger,
buy more,
greater volume. Yeah, exactly. And we have more brands, so we have some leverage there. We cut the cost of logistics because we now have like one centralized warehouse rather than 3 or 4 warehouses for each brand, and we also renegotiate with the logistics providers. And then on SG&A, rather than having one brand manager per brand, we can have one brand manager for 2 or 3 brands. So yeah, that's the main ways we cut costs.
That's interesting.
Did you want to say something, Martin? Because I have another question. Sorry.
Go ahead, Michael.
So do you think with all this data, how many brands have you bought so far?
Not very many yet, but we seem to have much more. So we bought 4. We've signed term sheets with 15, and we will have like 10 in the next 2-3 months, I'd say.
Wow, I'm gonna have to say congratulations again on raising all that money, because it's a real belief. You know what I mean? If someone's, I mean this really seriously. Like the equity and the, like, you weren't kidding when you said you had no revenue, but the equity and the debt you've been able to raise for people that just go, this has to work. That's pretty impressive, actually. No, I mean that's really impressive.
People are basically looking at us and saying there will be an e-commerce consumer conglomerate in the Middle East. Whether it's these guys or somebody else, maybe it's somebody else, maybe it's these guys. And they're like, if we throw money at the right team, hopefully we can back the right horse. And that's what they're sort of gambling on, is that we're the right team, I think.
So here's my question. No, let me do this one. Sorry, here's my question. You have 4 brands, you'll have 15 brands, it doesn't matter. Once you get to like 30 brands, you're going to have just a ton of data, a ton of sales data, a ton of turnover data, like just a ton of data. You'll understand marketing better, you'll understand warehousing better, all these things. Do you think you'll get to the point where you'll be like, wait a second, instead of acquiring brands,
yes,
why not just build it from scratch since we know already, kind of thing?
Yeah, definitely. We already tried to do it, actually, but it was just
too early, though.
Yeah, a bit too early and too slow. I mean, I think we'd have a fair shot of building some decent brands now, to be honest, even just because the people that build brands now are not like very systematic about the way they do it. They're not looking
not at all.
At like, okay, here's what's being searched for versus what's there, and there's a gap here and we can do that. They're just building that, they need the thing that they wanted to build, so they built it and it became successful. Usually is what happened. I think we could have a decent crack at building some brands now. The thing is, it's just slower than buying. So until we have capacity to do that, then we probably won't do that, because right now we're so focused on the acquisition bit that
but can I just give you another thing that I think about?
Go on.
I think about your business as like getting all this experience, understanding how brands get built, and then almost becoming like a startup studio, right? In the same way that like some VCs say, we'll invest like $2 million, we'll take 10% of your business, or we'll have EIRs, right? So entrepreneurs in residence, we'll take 50% or 30% of that business, we'll fund it. But from all the stuff we've learned by building and investing in other companies, now we can do it faster by having a startup studio. Do you think that there is value in having sort of a e-commerce startup studio brand in the markets in which you operate?
Yes, actually, there's a few of them that are starting now, where they'll just be brand building studios, and I think their aim is to sell to Opontia. To be honest, I think that's they're building brands basically to sell to us, which is great for us because that's more brands for us to buy, which is good. Yeah, definitely. And you're right, though, also on your first point, which is as we get more data, we will have a massive advantage in knowing where the gaps are and what products will be successful, and then it'll make more sense for us to start. And also, it's not just building brands from scratch; it's also product line expansion. We've already started doing that a bit with Novimed, launching some new ancillary products.
Yeah, and the other way I think about this as well is, we talked a few minutes ago about how there's less risk in a Series A or a Series B investment because they've already confirmed product market fit and they're funding growth or accelerating growth. But the real returns, right? So if you'd invested $100,000 in Uber, like Jason Calacanis did, you could have turned it into $100 million. It could have been zero too, but your downside risk is limited and your upside return is huge. So it's maybe faster to build after you buy something, but the returns could be much bigger if you allocate some of those resources to just brand building. Was the only thing that I was thinking.
Definitely.
Yeah, if that makes sense. Sorry, Martin, I've interrupted you for the last 45 minutes.
That's okay, Michael. No worries. No, and I was just thinking that maybe you can work with the sellers, like the guy who just sold to you, and this guy is an amazing entrepreneur. He knew how to build a brand and all of that. And on your side, you see data, you see gaps, and you say, hey, guy, now that we bought your business, why not you work on that and you build this new brand with us, right? And here is some fun. Do that on your side, and as Michael said, when you become an entrepreneur in residence, you get 30, 40, 50% of this brand, and then you just keep doing it this way.
Yes, we're considering doing this. We're considering doing this. We're just honestly too bogged down in trying to execute the.
That's only 9 months. That's only 9 months.
This is not like a not a questioning of the strategy. It's just like you're so inside of it. Yeah. There's nobody else to ask about what it looks like from the inside. Do you know what I mean? And every business that's as early as yours, you're focused on this one thing. We know we can do this. We'll do it really well. But I'm just curious, like if in those meetings, this is why we're asking this. It's not like, how come you're not doing this? It's more like when you're sitting around and chit-chatting going, do you think that would work too? Maybe even 2 years down the road? Because look, you're a bunch of smart guys, right? So you must be having these conversations, right?
Yeah, definitely. Yeah, no, we definitely are having these conversations. And brand building is definitely key to it. The business moves from acquisition to being an operator of brands very quickly. And once you're that, you need to be excellent at it. And that means brand building and everything. Yeah.
And what's the end game for you guys, right? In other words, you raise money, you raise debt, whatever it is, you have this expertise in building and growing brands, whether it's, like you said, channel expansion, market expansion, all this kind of stuff, right? Regional expansion. You keep buying brands, you keep getting bigger. And you use the word e-commerce conglomerate. I think I'm going to use that from now on because I love this term. But once you become this e-commerce conglomerate, do you just keep going, or does somebody buy that too? Do you know what I mean?
Yeah. It's funny that you love that term. So we used to have on our front page of our slide deck, it used to say, building the next generation e-commerce consumer conglomerate or something like this. And one of our investors told us that it was too corporate and like too ugly to say conglomerate. You have to say like e-commerce group of the future.
That guy was wrong, by the way. Anyway.
I don't know. Conglomerate to me does sound a little bit like a bit evil. Every time I think of the word conglomerate, I think, they probably did something evil to become a conglomerate.
You just think of Halliburton. But don't you think though that in the building, so every e-commerce company, every startup company, wants to be like a pirate ship, right? They just want to go their own way. They want to sail against the tide. They want to do this thing. But the bigger they get, the more they just turn into the Navy. And I don't think there's any way not to have that happen, because there's a reason why those businesses turn into that. It's because you've got to have process control, management control, and all this other stuff. And you can do, when you're small, you can be a pirate ship. Yeah. But when you're big, you can't. Yeah. Is that fair?
Definitely. One of my favorite podcasts is that Blitzscaling with, have you ever watched the Blitzscaling with Reid Hoffman, and he interviews like 15 different, do you like that or no? No, you don't. You hate it.
I hate it. How many times do I need? So Reid Hoffman is really great, but the only thing he's ever built is LinkedIn. And that was like 15 years ago.
LinkedIn's pretty good though, to be fair.
Yeah, but wait a second. It's 15 years ago.
Didn't he do Netflix as well or something else?
No, that's Reid. No, that's a different Reid.
That's different.
Reid Hastings.
Oh, yeah, that's it.
As a matter of fact, Reid Hastings, I'd love to listen to, because Reid Hastings took a business that was DVDs in these little boxes and turned it into streaming. That conversation I really want to have, because what that dude did was amazing. And he took his entire management team that was doing the DVD delivery business and threw it away because he knew they didn't have the core competency to build the digital business that was necessary to run the streaming. That's actually super cool. But I'm frankly, the reason why I want to talk to you, and I mean this, the reason why I'd much rather have you on the show than Reid Hoffman is because you're in the weeds right now. And it's visceral for you. You can feel it. When you're done with this call, you're going to be like, oh, how do I fix that thing?
Yes, that's very true. That is good.
But you know what I mean? That's the story that I want to tell.
I've actually just pushed another call back because I'm enjoying it.
Right? And while you're on this recording, you're just thinking, when is this going to end? Because I got to fix stuff. But what Reid Hoffman is doing is just regurgitating the same stuff over and over again.
I won't quote Reid Hoffman, but on his podcast, he has as a guest the founder of, is it Square? No, not Square. Sorry, Stripe. Who's those Irish twins? I can't remember, or brothers.
Yeah, the Irish brothers. Yeah.
Yeah, and the guy's like, he's talking about like management structures and like hierarchy in organizations and all this. And because I'm expecting him to be like, well, yeah, no, we throw that out the window and we just have a flat structure. And he's like, yeah, no, it's worked pretty well for like hundreds of years. So we just carry on. Like, I was like, yeah, you actually don't need to reinvent that bit. That bit's like fine.
That bit works. That bit works.
So yeah, we're in that phase.
Yeah.
Actually, if I may, Michael, you asked another question, and we didn't have the answer about your exit. Like, what is your
the exit
strategy, and for your future? I'm super interested into that. Sorry to go back to this question.
Yeah. So I mean, our aim is to build a standalone, profitable sort of cash generating machine that could be IPO'd easily.
Got it.
And that's what our target is we're not building something that just to be acquired or whatever. We're trying to build a proper standalone business. Having said that, and that's sort of our North Star. If we are making decisions, we would rather keep that in mind. But if you ask me what I think is likely to happen, it's probably a bit different, which is there probably will be some global roll-up of these business models. Now, what I don't know is what price they'll be rolled up for, because Thrasio buys businesses for 5 times EBITDA. We would never sell for 5 times EBITDA. We would only sell for 15 times EBITDA or 20 times EBITDA, which is what Thrasio trades for, by the way. So then the question Thrasio has to ask themselves is, do we waste time deploying capital into an Opontia at 15 times EBITDA, or do we buy more Amazon businesses for 5 times EBITDA? And right now they're going to say we'll buy more Amazon businesses for 5 times EBITDA. But maybe at some point they say we've run out of Amazon businesses. But then,
what do you do if they come in and start buying businesses in the UAE? And because you just said it, right? Like, if they have to pay 15 times EBITDA for you, but you're acquiring brands at 4 times, why not just disintermediate you and buy the brands there with all that cash?
Well, one thing that I think is very good about our strategy is it's super hard to launch in our markets. It's really not that easy for them to just come and buy brands in UAE and Saudi.
Good answer.
I mean, it took us 9 months to get a bank account in the UAE, and that's not because we're not connected. I had to get the Minister of Commerce to write to Emirates NBD Bank to get us a bank account. It's unbelievable how bad and slow business is here. I mean, this
is the point I wanted to make, though, right? Because the question that I asked is a question that other people are going to ask because they don't know how hard it is to operate there.
Yeah.
Go ahead.
Like in Saudi, for example, I basically lived in the Ministry of Foreign Investment in order for like 2 weeks to get us for 2 months I was trying, but for 2 weeks they gave me a meeting room where I just sat in this meeting room for like 2 weeks in the Ministry of Foreign Investment to get an exemption so that we could be 100% foreign owned company with a trading license. Otherwise, we'd have to have a 51% local Saudi partner, which would mean we'd not be able to deploy debt.
Right.
So, and if Thrasio want to come into Saudi and be 100% owned, they have to, on day one, invest $200 million. And we got it because we have an entrepreneurial license and our VCs are extremely well connected. Maybe I don't think Thrasio will get this exemption. No matter how much money they pump at it, they won't get this exemption. So it's things like that. And also, then what are they going to do? They're going to set up the whole warehousing and, it's not like launching a new Amazon business. It's much, much more difficult. So I think we're a strong acquisition target because they won't want the pain and the hassle of having to set it up themselves.
That's a great answer. And that's actually kind of the answer that I expected. It's the same thing here. People always just say what if Amazon just rocks up into Thailand?
Yeah.
Well, there's a reason why they haven't.
Yeah.
Right. There's a reason why they're in Singapore and not here. And that's because it's hard.
What do you think about Shopee absolutely dominating Lazada?
Well, because Shopee comes out of the, I don't like the name of this company, the old Garena business, right? It's now called SEA or C. I don't know how to pronounce it.
Yeah.
Look, Lazada's it's a pretty bad business. Discovery is really hard. Search is really hard. And the service is not so great, right? And if you know the way that Rocket Internet was building businesses in Southeast Asia back then, it was just build to sell. And almost all of their later stage investors lost money, right? Because most of them invested at a $3 billion valuation and sold to Alibaba for $1 billion. So yeah. And I know most of the people that founded it because I was here the whole time, and most of it was founded actually in Thailand, not in Singapore, even though the entity itself was a Singapore entity. So it's not, look, it wouldn't have been hard for a company that was well funded to build a competitor to Amazon. I mean, not to Amazon, to Lazada, and that's just what Shopee did. Yeah. So not surprising, I think.
Yeah.
Anyway,
how did you guys get into e-commerce? Like, of all of the cool tech things you could have picked from finance, well, not cool, but like fast-growing tech things, like why did e-commerce stand out? I mean, not crypto or anything else.
So I'll let Martin answer in a second, but for me, I want to own every conversation in Southeast Asia that has a tech angle to it. My Asia Tech podcast is a test bed for conversations. And if there's interest in a conversation that's there, I spin it out into another bespoke show.
Nice.
And e-commerce just people care about, and it's not solved. Like, it's just not done yet, right?
Yeah, definitely, 100%.
And I just thought nobody else is talking about it, so let's Martin and I talk about it. Martin, on the other hand, I'll just say a little bit, Martin, you can finish the thought.
Let's go.
Is building a competitor to Shopify.
Really?
Yeah. And doing pretty well. He gets hundreds of customers, new customers every month. Most of them come from Shopify because he's built a better product.
Amazing.
Yeah, and frankly, if you have guys and gals that want to sell on an e-commerce platform, you should have them build their stores on Dr. Tech as opposed to on Shopify. It's cheaper, it's easier, and it's better.
I'll tell people.
Anyway,
you should get my brother on. My brother, yeah. Do you guys know Una Brands?
I've asked everybody at Una Brands to be on the show, and all I get is, let me do this.
No.
Oh, don't worry. My brother is I was about to say a very rude word, but my brother is not. he'll do.
Hey, don't say it.
I'm not gonna say it. Don't worry. He'll do the show. Don't
worry. but how come you are building Opontia in the Gulf and you have your brother building Una Brands in Southeast Asia? Like, how come you have two companies? Why don't do it together? Or like, how do you come to it?
He moved to Australia with his husband in like October in 2020 during pandemic, and he couldn't really leave. And I got funding for this business in like January, and then I put him in touch with my investors, and they were like, "You should speak to this guy Kieran, who's doing it in Southeast Asia." And then he was thinking about doing it, and then they sort of joined up and co-founded.
Okay.
Yeah. So they're business partners and they're partners as well, right? I'd love to get them on the show. Like, we've asked them. We've reached out to them. And I know a guy that used to work at What's your brother's name?
Adrian. He's based in Sydney. Yeah. He's based in Sydney. He'll definitely do the show. I promise you 100%.
Send him to us because
I'll make the intro, don't worry.
Yeah, please do, because the Southeast Asian markets are so different than the markets in which you're operating, and you can tell, like, I'm super curious about this.
No, for sure. He'll do them. He'll do the podcast there. You have my word. If he doesn't, send him my way and I'll beat him up next time.
Okay, no violence. I don't approve of violence.
A little bit of violence.
I'll leave that to the brothers. It's fine with me. I've got a brother as well, though not a twin. Anyway, look, it was great to have you on. I really want to thank you, Philip Johnston, the co-founder and this co-CEO of Opontia. Thanks for coming on the show, man. We really appreciate it.
Martin and Michael. Thank you so much for having me.
Thank you very much. Bye-bye, guys.
Ciao, bye.